Hi everyone, welcome back. In today's video, we're going to explore a critical concept in economics, market equilibrium. We'll break down what market equilibrium is, how it's affected by shifts in supply and demand, and the role of the price mechanism. We'll also discuss the importance of allocative efficiency and how surpluses and shortages are managed in the market. So let's dive right in. Market equilibrium occurs when the quantity demanded of a good equals the quantity supplied. Diagrammatically, this is the point where the demand curve and supply curve intersect. At this point, we get both the equilibrium price, PE, and equilibrium quantity, QE. But what happens when there's a disturbance to this balance? Well, shifts in either the demand or supply curve can create surpluses or shortages, which moves the market out of equilibrium. Let's look at an example of how a market can be disrupted. Imagine the market for coffee. Now, let's say there's a new trend promoting the health benefits of green tea, causing many coffee drinkers to switch to tea. This shift in tastes and preferences leads to a decrease in demand for coffee, which we can show as a leftward shift of the demand curve on a diagram. At the original price of coffee, demand is now much lower, leading to an excess supply or surplus. In other words, at this price, more coffee is available than people are willing to buy. The market cannot stay like this because producers are left with unsold stock. This is where the price mechanism comes in. In a free market, prices adjust to clear surpluses or shortages. With a surplus of coffee, prices will begin to fall. As the price falls, the law of demand and supply kicks in. The lower price encourages more consumers to buy, increasing the quantity demanded, while suppliers cut back on production, reducing the quantity supplied. Over time, the price continues to drop until the market reaches a new equilibrium, where the quantity demanded equals the quantity supplied once again. The importance of the price mechanism is that it signals producers to adjust their supply and incentivizes consumers to change their purchasing behavior, ensuring scarce resources are efficiently allocated. Now, let's talk about a demand shock, which is a sudden and unexpected increase in demand. A good example of this is what happened in the United Kingdom flower market following Queen Elizabeth II's passing. People wanted to honour the Queen, leading to a massive increase in demand for flowers. This rightward shift in demand caused a shortage, meaning there weren't enough flowers available at the original price to meet the sudden spike in demand. When this happens, the price of flowers starts to rise. As the price of flowers increases, it encourages flower suppliers to bring more flowers to market, increasing the quantity supplied. At the same time, the higher price causes some consumers who are not willing or able to pay the new price to exit the market, reducing the quantity demanded. This adjustment process continues until the market reaches a new equilibrium price and quantity. Now that we understand how the market reaches equilibrium, let's talk about an important concept called allocative efficiency. This occurs when the price and quantity in the market reflect the most efficient allocation of resources, meaning that the marginal social benefits of consuming a good are equal to the marginal social costs of producing it. When a market achieves allocative efficiency, both consumer surplus and producer surplus are maximised. Consumer surplus is the area on a graph above the equilibrium price and below the demand curve. It represents the difference between the highest price consumers are willing and able to pay and the actual price they pay. This is usually shown as a triangle on the diagram. Producer surplus is the area below the equilibrium price and above the supply curve. It represents the difference between the lowest price producers are willing and able to accept and the market price they actually receive. Together, consumer and producer surplus make up social surplus, which is maximised at allocative efficiency. Understanding this concept is important because it ensures that the resources in the economy are being used in the most beneficial way for society. It's also crucial to recognise the role of prices in this process. Prices act as signals to both consumers and producers. When prices rise, they signal to producers that more of a good is needed, incentivising them to increase supply. Conversely, when prices fall, producers are incentivised to reduce supply as the good becomes less profitable. Additionally, prices perform a rationing function, especially during shortages. When a good is in short supply, higher prices ration the good to those who are willing and able to pay, helping to prevent overconsumption. In summary, market equilibrium is the point where supply and demand balance each other out. However, this balance can be disrupted by shifts in either demand or supply, leading to shortages or surpluses. The price mechanism then kicks in to restore equilibrium, ensuring efficient allocation of scarce resources. Allocative efficiency occurs when marginal social benefits equal marginal social costs, maximising social surplus. Thanks for watching. I hope this gave you a clear understanding of market equilibrium and the role prices play in resource allocation. Be sure to like, comment and subscribe, and I'll see you in the next video.